So now what are open-ended funds, friends? Now open-ended funds are the funds where investors can buy and sell units of the fund at a NAV related price at any time directly from the fund. So what happens is, if let's say I want to enter a particular fund, I want to invest in a particular fund, there is a ready NAV available for that particular fund, I can buy it, and if after a certain period I want to come out of that fund, I can easily do it by selling my units. So that flexibility is available in case of open-ended funds. So giving an example, open-ended schemes are offered for sale at a pre-specified price, say rupees 10 in the initial offer period. After a pre-specified period, says 30 days, the fund is declared open for further sales and purchases. So there is flexibility wherein the purchases and sales can happen for a fund which had just been initiated or which had been brought into the market through a NFO. Now what do you mean by NFO, friends? NFO stands for new fund offer. So what happens is, I come up with a new fund, right, that will have a face value of rupees 10. So per unit price for that fund will be rupees 10, and then after 30 days I will declare it to be open, wherein the new buyers and new sellers can come into the market and do the trading, right. So the buying and selling in existing fund can be done in open-ended funds. Investors receive account statements of their holdings. The number of outstanding units goes up and down. The unit capital is not fixed but variable. The corpus of an open-ended scheme changes every day. Why it keeps on changing every day? Because let's say there were in all 10,000 units, right? So the corpus of AB fund, let's say let us give a name to a fund. AB fund has a corpus of 10,000 units, right. Now what happens is, as the NAV keeps on changing, the number of units that are existing in the corpus will also change. And when the units changes or when the corpus changes, what happens is, there might be 10 new buyers, there might be 20 new sellers. So since there is a difference in the number of buyers and number of sellers, the units keep on changing in case of open-ended funds, which is not there in case of closed-ended funds, right. So what happens is, the number of outstanding units that is there for a particular fund keeps on varying. Now what are closed-ended funds, friends? A closed-ended fund is open for sale to the investors for a specified period, after which the further sales are closed. Now what is the basic difference? Here I said, in open-ended, yes, after the NFO is launched, after 30 days, once they are declared as open, buying and selling can take place. But in case of closed-ended funds, what happens is, there is only a specific period, let's say a month's time. Now what I do is, in a closed-ended fund, I say that it is open for 1 month. So for 1 month, anyone who wants to invest or who wants to purchase the units in that particular fund can come as a buyer. So what happens is, in closed-ended funds, let's say 30 days के लिए window open है. So for the 30 days, I can come and invest in this particular fund. But after 30 days, the window gets locked. Now after 30 days, there can be no further buying in this particular fund. In closed-ended funds, I cannot invest after the specified period. So now there is no more buying and no more sales that can happen in that particular fund. Any further transactions that happen in the secondary market where closed-ended funds are listed. So if let's say the closed-ended funds are listed, then yes, there is a readily secondary market available wherein the wherein the trading can be done for that particular fund. But through the mutual fund, I cannot do any buying and selling. The price at which the units are sold or redeemed depends on the market prices, which are fundamentally linked to the NAV. So what happens is, there is, as I said earlier, there is a NAV even for closed-ended fund. On a daily basis, the NAV is determined, and on that NAV only the transactions can take place. The selling or redemption can take place. The number of units of closed-ended funds remain unchanged. Why? Because there is no entry or exit into that fund, and that's the reason the number of units that are there that are making the corpus will remain the same. So there is a permanent or fixed number of units that are available in closed-ended funds. The unit capital is fixed because of one-time sale. So one-time sale में जितना भी एक बार में whatever I have collected in one go, that is what is available, right? That is what is making my corpus, and that is what is the number of units. That is the unit capital which is existing in that particular fund. After that, there will be no changes will be done. Now, what are the various types of funds? By investment object. As I said, the investors who come into the market, who want to invest in the mutual funds, they will have different investment objectives. They have a different risk appetite, they have a different temperament, they would like to have different funds for suiting their objective or suiting their requirements. So, on that basis, there are a variety of funds which are available in the market. To name a few, there are equity funds. Equity funds, they are directly getting into the equity market, right? So, equity funds are the funds wherein the major portion of the corpus or the major portion of the pool of funds that are collected will be routed towards equity, right? So, it will be going directly into the equity market. It will be for the purchase of the shares of various companies, right? So, there the allocation, it can range up to, it can go beyond 80 to 100%. So, 80 to 100% of the total corpus can go towards equity investment. So, that is what is equity fund. There are variety of equity funds available in the market, which are ranging from sector funds and index funds. So, there are in equity we have different types of funds. Then comes the debt funds. In debt fund, what happens is the allocation is more towards the debt instruments, right? Why? Because as I said, the risk appetite. In case of equity, yes, the risk is pretty high, and that's the reason there might be a set of people who will not be that comfortable investing into the equity. As I said, equity funds, the risk is pretty high, the risk exposure is pretty high, so it might not suit those people who are risk averse, right, who doesn't want to take any risk. For them, debt can be a better choice. Debt is a fund which is going to allocate maximum portion of the fund into debt instruments, right? And then in debt also we have a variety of funds which are fixed income funds, gilt-edged funds. So, there are different types of funds for the debt category also. Then comes money market instruments or money market mutual funds. So, money market mutual funds are basically going to invest in money market products, that is either a call money, a treasury bill, a G-Sec, so government securities. So, any investment which is being done in the money market will be routed through money market mutual funds. Now, there is another combination of, they can be hybrid mutual funds also, that is I have a combination of two investments or two markets. So, there is one equity market, there is debt market. Now, there is someone who is who partially wants to take risk, right? He wants to have a balance between the risk and the returns, right, and the liquidity, let's say. So, if he is a person who wants risk, he wants a little exposure and risk, but at the same time concerned about the principle, about his principle, what he can do is, rather than going only into equity or into a debt fund, he can have a fund which is called as balance fund. So, balance fund, what they are going to do? They are going to balance it. So, what the allocation will happen is, the allocation will happen as 50-50, right. So, in a balance fund, I am going to allocate 50% of the total corpus, total pool into equity, and 50% will go into the debt market. So, it is a combination now. So, what happens is, now another investment objective can be, I want to have a risk exposure, but at the same time I want to take care of my principal. For them, the best fund will be a balanced fund. Now, there might be a person who is a risk averse, who doesn't want to take risk at all. He is comfortable doing his investments in debt market, but as we all know, debt instruments are long-term instruments, right? There I need to wait for a pretty long time to get the returns or to get my money back. In such a case, if the concerned investor, if the investor has an objective of getting decent returns, but at the same time he is looking out for liquidity, in this case he can enter into liquid funds. So, liquid funds is a combination of debt as well as the money market. Under equity funds also, there are variety of classifications, or there are variety of choice available. Now, what are the various equity funds that are available in the market are aggressive. Now, something wherein I am ready to take a lot of risk. Why? Because I am concerned more of returns. I want good returns no matter what is the risk exposure for me. In such a scenario, for such investors, the best equity fund will be aggressive growth fund. Why? Because they target maximum capital appreciation. Here they are more, the funds are more channelized towards small cap companies, right? The small cap companies where the volatility is pretty high, such companies, such funds are called as aggressive growth funds, right? Then comes the growth fund, where I am looking out for a capital appreciation over 3 to 5 years. Rather than having spontaneous returns, I am ready to wait for 3 to 5 years to get a good appreciation from my equity investment. For them, the best investment will be growth funds. So now the next category of equity fund is specialty funds. Now what are specialty funds, friends? Specialty funds are funds which are going to focus only on one particular sector, right, or on one particular objective. So let us talk about sector funds. Sector funds are the funds which are going to channelize the major portion of the pool funds, that is the pool of funds, in a particular sector, whether it is banking sector, it is power sector, pharma sector, IT sector, telecom, FMCG, any sector wherein they feel that the potential is pretty high and they want to just focus on that particular sector. Such funds are called as sectoral funds, right? Then we have foreign securities funds, where the investments or the pool is going to invest in securities or in shares of different countries to make it more diversified. So if I want to have a better diversification of my portfolio, I can also choose foreign securities fund. Then we have mid cap, small cap equity funds, wherein if I say mid cap fund is going to just pour in all the, or they are going to channelize all the pool of funds into mid cap companies. And if I say small cap equity fund, they are going to route all the funds to a small cap, to all small cap companies. Then we have option income funds that doesn't exist in India, but then they are funds which have a call and put option inbuilt in it. So such type of funds are not there, they don't exist in India. Then we have diversified equity fund, which do not focus on one or two sectors, but they are going to diversify across various sectors. Then equity index funds are the funds which are going to do investments into some indexes, right? So whether it is a Sensex or a Bankex or whether it is Nifty, so it is going to be a basket which they are going to purchase, that is called as equity index funds. Then we have value funds, wherein invest in companies whose shares are underpriced. So through a proper study, through a proper analysis, I can through the CAPM model, that is capital asset pricing model, I can understand, I can evaluate which companies are overvalued and which companies are undervalued, right? So on that basis, I can decide if they are underpriced, I can select, the value fund can select all those companies and do the investment in these companies. Then equity income or dividend yield funds, they are basically those companies which have a good dividend history. So those who have been paying good dividend or they have a high dividend yield, such companies are preferred for routing the investments through equity income or dividend yield fund. Then the liquid or the money market funds are the funds, the debt funds invest only in instruments which has maturity less than a year. As we all know, what is a money market? Money market is a market for short term instruments, right? So basically the short term instruments are available maximum for a period of 1 year. They are lowest in the order of risk level. As we all know, higher the risk, higher the return, lower the risk, lower the return, lower the returns. So what happens is, when I talk about liquid or money market funds, though they have a very less risk exposure, the risk is pretty less, but the returns are also very they are not that great. So the way I can earn through an equity fund, they are not available in case of liquid funds. So if let's say I talk about good returns of 12 to 15% or for that matter 20% in equity fund, here I can expect maximum to 6 to 8% returns coming. That too also I am talking on the higher side, but then yes, in liquid funds that can be the maximum which I can expect. The investment portfolio is very liquid and enables investors to hold their investments for very short horizons even for a day or more. So it is basically for those people who have a huge volume of funds available, but then the funds are available only for a temporary period, say for overnight or for a week's time. In such cases, rather than going into the equity route or getting into an equity fund, they will prefer to go in through a liquid fund, right, a money market fund. Now, what are gilt funds, friends? Gilt funds are the funds which invest in securities that are issued by the government and therefore do not carry any credit risk. When I talk about government coming into the picture, as the securities of the government, the government securities are going to be purchased through this fund, there the credit risk is pretty low. It is in fact negligible. The government papers are also called as dated securities, and it invests in medium to long term government papers. Ideal for institutional investors, so those institutional investors who are looking out for security, for liquidity, for them this can be the better choice, right? So they can go in for gilt funds. Now there is another category of fund which is called as equity linked saving scheme, ELSS. Nowadays it is really coming up and the investors have also started investing in this type of schemes, which are the features of ELSS is they are 3-year lock-in period. So they usually have a lock-in period. In ELSS, once I have invested in that particular fund, I cannot come out of the fund before 3 years. So 3 years is the lock-in period for ELSS. The minimum investment of 90% in equity markets at all times. So ELSS, again, it is a equity, it comes in the equity category, and since it is in the equity category, 90% of the funds are allocated into the equity market, right? So ELSS has a 3-year lock-in period, and then the major allocation is towards the equity shares. It can be, I can come up in any format. It can be open-ended or a closed-ended scheme. Eligible under section 80C up to rupees 1 lakh. So I can get now if anyone is looking out for tax benefit, yes, ELSS can be a better choice for him. Why? Because under 80C he is going to get a tax exemption, he is going to get a rebate up to rupees 1 lakh. The dividends which are declared under ELSS are purely tax free. The benefits of long term capital gain taxation. So here, as they are going to be locked in for 3 years, I get the benefit of long term capital gains. Now there is another category of investment. As I said, the mutual funds are structured, are designed in such a way that they cater to the requirements of different category of investors, right? So they are trying to serve every category of investor, whether he is he is a person who is looking out for returns, whether he wants something wherein he can have a disciplined way of saving, whether he wants he is ready to take risk, whether he wants liquidity. On the basis of the objectives, there are different mutual funds that are available in the market. Now one fine scheme or one fine series is the fixed term plan series. It is also called as FMPs, fixed maturity plans, right? So the fixed term plan series are basically closed ended. So the first feature that the FMPs have is they are closed ended in nature. So there is, I cannot, once it is open for a particular time period, for a specified period, during that period I can invest into an FTP. Once the investments are done, the window is closed and there is no more buying and selling that can take place. So it's a closed ended scheme. The AMC issues fixed number of units for each series only once and closes the issue after an initial offering period. So once the NFO for the FTP comes in, they are open for a specified period. The AMC is going to issue the units as per the investments that are done, and once that period is gone, the issue is closed. The fixed term plans are usually for short term, that is less than a year. So they are the best investments for short term purpose. So if anyone is looking out for short term investment, FTP can be a better choice. They are not listed on a stock exchange, so there is no such secondary market for the FTPs. The FTPs series are likely to be an income scheme. So anyone who is looking out for having a good income, a good return, but a decent return, in fact not a good return. Why? Because they are not having any exposure in the equity market. They are good alternatives for bank deposits and corporate deposits. So, someone who is looking out for another option rather than a bank deposit or a corporate deposit can look out for FTPs or FMPs. Now, there are commodity funds also which are available. Now, what does commodity funds do? Now, commodity funds are going to invest directly in the commodities or through shares of the commodity companies. So, companies who are into that commodity business, the investment is going to be rooted into those companies. So, that is the reason they are said to be commodity funds, or it can be through commodity future contracts also. So, most common example of such funds is precious metal fund. So, any fund which is going to invest in a precious metal, whether it is gold or whether it is silver, in such cases they are categorized as commodity funds. The gold fund invests in gold futures or shares of gold mines. So, this is how a commodity fund will work.